Welcome back, everyone. Michael here with Offshore Citizen. Today we're going to talk about a tax you've probably not heard of, but can be a little bit pernicious. It is in particular affecting Americans, although in theory it could affect foreigners as well. And this is called accumulated earnings tax. So AET for short. It is fairly recent tax, and fortunately not one that gets thrown in too much. However, it is very problematic because it's one of these kind of vague rules that they can sort of apply at their whim and go and pursue you with. So we're going to dive in and talk today about accumulated earnings tax and what it is, how it works, how it applies, and what you can do to prevent it or minimize the effects. So let's dive in and talk about that now. Before we do, if you haven't already, please hit the subscribe button, hit the all notification bell. Thank you for being here. Welcome. And if you're interested in help with international corporate structuring, setting up offshore companies, international tax planning, we don't just help you form companies. We can certainly do that as part of the services for you, but we help you to figure out what is the best place to set that up. And more importantly than where to set it up is what are the rules that you need to be compliant with around that to make it actually legal. What I always tell people is if you just form a company in some place like BVI, you will probably end up being fully taxed. There are all sorts of unscrupulous people who don't particularly care and are just going to sell a company and don't really understand the tax rules where you are. We specialize in understanding the tax rules all over the world and how they interconnect. And so if you're interested in that or help with moving to another country, getting residencies there, setting up bank accounts, all that sort of thing, please reach out to us. You can book a call with me, calendly.com/Michael-Rosmer, link in the description below, or send a message through offshorecitizen.net. Okay, cool. So accumulated earnings tax is a tax that applies basically to corporations. So C Corps, doesn't apply to X Corps in the US. And the concept here is that they know that you can earn money inside a company, not distribute the money to yourself, and use that as sort of a long-term deferral vehicle. That's basically the idea. And so as a result, they came up with this AET thing. Now, I find AET to be offensive. I think it's very bad when you have laws inside a country that don't have like a specific checkmark application or not. Like these become these vague ambiguities. I think they become a bureaucratic nightmare. It's quite a pain, but that's all the more reason that you don't want to fall into these. And so we're going to talk about kind of how they haven't been applied to certain companies and why they haven't been applied and some of that sort of thing, because I think that's important for informing how you should look at it. So the way this works is that they say, okay, well, if you have what they would call an excessive amount of capital above retained earnings in the company that are in a situation that they're not being, that it's excessive for the operations of the company, then they can apply this 20% tax to you. So 20% tax, let's be clear, is like pretty high, right? Technically, that's the federal capital gain, long-term capital gains rate for if you're in like the highest income bracket, right? So, okay, that's probably where they get that, but realistically, like maybe you're not in that income bracket, or you would have come in under it if you had simply, paid out the money. So what are we talking about here? The threshold for this typically is $250,000. Okay, so if you're like under $250,000, then typically they're not going to have a concern on that. However, $250,000 is nothing, like a super low amount of money. What are we talking about here? This is ridiculous, right? And the other problem with this is, how do you even know about this tax, right? Most people don't know about this tax. Why not? Well, it's not like you're filling out your tax forms and they're like, hey, listen, should you be paying AET? No, it doesn't work that way because it's so ambiguous, right? Like, how do we know whether this is a reasonable amount of money or not? Okay. Now, here's the interesting question. Berkshire Hathaway has like $300 billion in cash reserves or something ridiculous like that. Google, Apple, Facebook, Microsoft, Oracle, all these guys have like massive cash reserves. Why are they not getting slammed with this? That is like our first key. So they do typically look for it where it's owned by like a private individual, maybe a couple partners, etc. They basically don't look at it frequently when you're talking about public companies. And you can sort of kind of understand why, right? But that being said, it's really annoying. And so we want to use the big companies as a template for what we're talking about here. So Warren Buffett clearly is doing acquisitions. So here's the key, right? So R&D, operations, acquisitions, all business expansion, regular operations, legal liabilities, all of these things can be reasons to keep money inside the company, okay? Clearly the most scalable of these is potential acquisitions, clearly, right? Because you could, in the case of Warren Buffett, he could do an acquisition for $40 billion or something, right? And that's clearly what his company is doing. So that's an important thing to pay attention to, is like, okay, I kind of see here that I have to be able to build a case for myself that if the IRS comes to me and they say, wait a minute, what's all this money sitting in here? We don't want this money sitting in here. We want this paid out to you. We want our piece of the tax when you pay it out. We're like, no, I can't pay it out because XYZ, right? Now, part of that is a story. A bunch of this stuff, remarkably, I did a video on the art of transfer pricing a while back, remarkably is a little bit of storytelling, right? You sort of think, or at least I thought, not kind of knowing about it prior to learning anything about accounting, that accounting is like numbers, just like precise mathematics, etc. But then you start to realize, well, actually, there's some ambiguity. Like, what's the category of this here? Oh, like, maybe we have something that we can put as some special note that, we had to exclude this for XYZ reasons or whatever. Like, there's some storytelling around this, some massaging of how this fact gets presented, because it's just not that clear how some of these facts get presented. However, in order to strengthen that position, what we typically want to do is we typically want to actually try and build some sort of a track record around this, okay? So, unfortunate thing to have to do, but it is what it is. First of all, it's good to at least pay some dividends out, because at least then there's some sign of distributions coming out. Number two, of course, you're going to reinvest, run the business, etc. But number three, I think particularly on this acquisition side, if you start having a lot of excess capital, is to be looking at that. Now, to the extent that you can make some acquisitions, great, awesome. By the way, there are some things you can do with holding companies and like layering this between different companies. One company doesn't have as much money as the other one does, this sort of thing. So you can kind of build these complex, convoluted structures to sort of obfuscate what's going on in this regard. This being said, a pure passive holding company is actually more likely to be scrutinized than an active business, so you got to be a little bit careful there. However, one thing that certainly can happen is if you funding a subsidiary, that's like one way, doing a cash injection or whatever is going on there. And so that's something that is certainly worth paying attention to. But if you're not going to actually do acquisitions, at least documenting looking at possible acquisitions is an interesting thing to do, right? It's not that hard to do. You can, be on lists where business brokers are sending you possible companies. You can, go back and forth. It's not a terrible idea to look at in general. I mean, can be some good opportunities there. You can negotiate on some of them, which can actually be a really interesting way to get to know about the industry and competitors and that sort of thing. But you want to kind of provide some chain of history that is going to show that, hey, listen, I actually demonstrated the intention of doing this. And look, it's going to take $5 million to acquire this company. So we've accumulated, close to $5 million in the company. And each year we're going to accumulate some more because we want to be ready to be able to take these actions. And so therefore, we think we need XYZ. Of course, your accountants can create some assessments for you to kind of understand like what are the cash requirements going to look like. Cash flow statements can help you obviously a little bit in that regard, future upcoming expenses and all this sort of thing. And it's I think not an unreasonable idea to say that, well, we want to be able to fund operations for 12 months or whatever it is from existing cash. So anyway, this is the deal. It's 20% tax. It's like this sort of hidden tax because it's not necessarily there. It can just pop up. It applies for if you have accumulated retained earnings in the company. By the way, really, really important, like understanding basic accounting vernacular, I think is like highly underrated amongst a lot of people. Just knowing like what is turnover, what is revenue, what is profit, how are retained earnings different from earnings, what is a maintenance expense versus a capital expense, what are liabilities, what are assets, what is cash flow statement versus an income statement versus a balance sheet, what kinds of information is included on those, why do they call it a balance sheet, what is shareholder equity, like in immersing yourself, it doesn't take that much to learn this sort of stuff, but it will help you a lot as you do investing, as you do business, as you deal with accountants, as you deal with tax people, etc. So well worth engaging in that. So retained earnings, for those who are not familiar, is the profits that have stayed in the company kind of after sort of, it could be whatever accumulated years. So let's say that I make like $500,000 and I don't pay that out, right? And so now I'm having retained earnings of $500,000. So I could pay it out as a dividend, that would reduce my retained earnings, or I could spend it, then it would not be earnings anymore, or it can stay there. And if it stays there, then it goes from being earnings to being retained earnings. And the point of retained earnings is it can accumulate, right? So maybe you have $500,000 this year, but then you add another $500,000 next year, and now you've got $1 million of retained earnings, or $2 million of retained earnings, or $20 million, or whatever the number happens to be. So that is the concept of retained earnings versus earnings. And I had a terrible experience where somebody I was doing business with didn't understand that and negotiated based on one, not understanding that it was the other. Big mess. So really, really important lesson to learn. Anyway, your retained earnings over $250,000. Clearly, there are lots of cases where businesses are in a situation that they don't have to worry about that because they actually can justify through the business operations that, hey, they need a bunch more than $250,000, but $250,000 is just an unreasonably low threshold, in my opinion. The one good thing about this is they would typically have to audit you or do something similar to kind of get into this. So your chances of having them come after you is fairly low, but you should watch for it. And if you're starting to accumulate a bunch of money, if you've got $1 million, $2 million, $5 million sitting in the company, start to think about this and plan around it. I hope that helps. If you have questions, put them in the comments below. Reach out to us if you want help with kind of international tax planning, etc. And I look forward to seeing you on the next video.